Hello and welcome to Market Cafe. You're watching with me, Ankita and Snehi. Good morning to you, Snehi. It's a fresh day of trades, and before we begin with the news flow, we have to first go across the global markets, Snehi. Let's quickly go across the global markets and see what happened there. Well, first up, US markets all ended in the red. Dow shed around 199 points, ahead of the Thursday data that is likely to come out today. Couple of data points. Technology stocks were the biggest underperformers, with Nasdaq Composite closing 1.1% lower. Nasdaq also notched a third consecutive losing session, if you will, dragged by more than 3% decline in the shares of Apple and Nvidia. Now, higher treasury yields have also been adding a lot of pressure, on stocks lately, especially the tech stocks. The 10-year treasury yield was higher at a good 4.3%. Now, jobless data's non-farm productivity unit labor cost data is likely to come out today, and the composite purchasing manufacturers index and ISM non-manufacturing PMI data are all expected as of today, and speeches from Hawker, Williams, Bowman, Logan and Goldsby are also due as of today. So a lot of important data points that will be coming out from the US market. So that is something all the investors are watching out for very closely. European stock markets also closed lower, ended with cuts. Taking a cue from the US markets, Stock 600 ended 0.6% lower, with most of the sectors in the negative territory. Household goods led losses, down by 2.2%, followed by banks, which dropped 1.5%. DAX and FTSE also ended with cuts, down 0.1% in trade. So a sea of red coming in there, Snehi. But tell us where the crude is at.
Absolutely, Ankita. Now, a key data point that we've also seen coming from the US is the US services PMI, which we will touch upon later. But let's also look at the crude check, and oil prices settled higher on Wednesday, reversing early declines as traders anticipated further draws on US crude oil inventory following extended production cuts in Saudi Arabia and Russia. Now, Brent crude futures settled up 56 cents to that $90.60 a barrel, so $90.60 a barrel, holding on to that $90 per barrel mark. On the other hand, you had WTI futures settled up 85 cents, also with an uptick to that $87.54 per barrel mark. Now, both benchmarks rose by $1 and then started to pair gains. But on the other hand, on Tuesday, Saudi Arabia and Russia extended voluntary oil supply cuts to the year end. The Saudi cuts were by 1 million barrels per day, while Russia has cut 300,000 barrels per day. Now, these were on top of the April cut agreed by several OPEC and OPEC Plus producers running to the end of 2024. Now, both of these countries, that's Russia and Saudi Arabia, will review market conditions and make monthly decisions on deepening cuts or raising output. So we'll have to wait till then to find out what these countries decide. And oil prices were down early on rate hike concerns and investor worries about the economy after data showed that the ISM non-manufacturing purchasing managers index, which is the services PMI, came in at 54.5 compared to the expectation of 52.5, so a pickup there as well. And against a basket of currencies, the dollar rose to a high of 105, above the 6-month high of 104.9, which was touched overnight. Now, a stronger dollar can weigh on oil demand by making crude more expensive for holders of other currencies. So this could further lead to a price build-up in crude. So this is largely what crude looked like, and this is largely what crude did in trade. But with that, Ankita, take us through all the important cues that we need to keep on our radar this morning.
That's correct, Snehi. There are a lot of important cues, like I mentioned at the start of the show. US, a lot of data points, jobless claims, Eurozone GDP numbers, China trade balance, US crude oil inventories, all likely to come out today. And of course, today is Thursday, so weekly expiry is also happening today. And in corporate action back home, we have Geo Financial that will be removed from NSE as of today, and that is something that we have been speaking about for a while now. Nazara Tech, Veranda, they both meet to consider a fundraise, and we have Tata Nexon's EV that will be getting a facelift, and that look will be unveiled today, and we will be getting you all the action from there as well.
Alright, and with that, let's also look at other important global stories that we've been tracking for you. And in the latest this morning coming in, tech giant Apple has struck a deal with ARM. According to the deal, Apple has secured access to a core piece of intellectual property, the ARM architecture. Remember, ARM is set to debut on the Nasdaq in the coming weeks at a total valuation that could be as high as $52 billion.
And shifting gears, then US has gone ahead and announced the extension of China's Sections 301 tariff exclusions on imports and select COVID-impacted categories until December. Now, important to note, the two sides might also consider extending it further under a 4-year review.
And shifting focus to some policy action, the Bank of Canada has held its interest rates at 5%. The central bank believes that the economy has entered a period of weak growth and will not shy away from raising borrowing rates should inflationary pressures persist.
And well, ahead of the G20, there is a huge demand for luxury cars. The government has also bought in over 3,000 luxury vehicles to the national capital to cater to the heads of states and other special guests who will be arriving in India for the G20 event. Now, there is a special ET Now report. Let's take a look at that.
Luxury cars are in high demand in New Delhi as the national capital prepares to host the G20 summit this week. This is going to be India's first G20 summit, and this two-day international conference is about to happen on 9th and 10th of September in the national capital of the country. As part of the preparations, over 30 luxurious hotels have been booked for the stay of the G20 delegates. The event will likely see the participation of around 29 heads of state, including those from the member countries as well as those from invited nations. The Delhi government has already declared a public holiday from September 8 to September 10. Hotels around Delhi NCR region have been sold out. Demand for vehicles to transport G20 officials has jumped at the same time. According to industry estimates, there is a demand of around 3,000 luxury vehicles in the national capital due to the G20 summit.
So till now we are providing over 1,050 vehicles, which and our customer base is the Government of India, Ministry of External Affairs, and we are providing services to 17 out of 25 embassies. So in total, I think we are giving about 60 to 65% of the total market requirement.
And has there been any shortage? What is the rates like when you were talking about luxury car rentals, the per day rates that you're offering right now?
So per day rates have been, they started off say at, for example, 100%. Now they've gone 4x, 5x. So since June, we signed our first contract for the G20 in March. And since then we've been going ahead. So if I take the March tally, I think now the prices is 4x of what it was. But we are still in a happy space because at that stage we had booked the vehicles already. So we have reached what the targets that we had set off for the G20. So we're happy now. We just need to ensure that the week is kind to us and we're able to deliver on the expectations of the customer.
The national capital is all decked up to host the G20 summit. Whether it's from hotel preparations to luxury car rentals or even the security managements. We are all fully geared up in the run-up to the G20 summit. And with this, India will become the first South Asian country to ever host the G20 summit.
All right, that's the word coming in from the national capital that is all geared up to host the G20 meet. But let's get a move on then. And according to sources, a report is ready on carbon pricing issue ahead of the G20 meeting. Now, the report is set to have recommendations to tackle the same issue. My colleague Prakash Priyadarshi has more details on this report. Prakash, take it away.
Yes, we are learning from our sources that G20 report on macroeconomic risk is ready, and it has made several recommendations which is with regard to climate financing and carbon pricing issue. As you are aware, the carbon pricing is something which is one of the important areas where discussions are taking place across the globe, and some countries are looking at possibility to impose carbon tax or additional pricing on carbon intensive products in order to reduce carbon emission. So these are the important areas where discussions have taken place at G20 platform as well under India's G20 presidency. And some recommendations have been made. Sources are informing that it has been recommended that carbon pricing should not be used as only tool to deal with the carbon intensive products. Of course, some other mechanisms should be adopted, and a non-carbon pricing mechanism should also be looked at as to how this issue is going to be resolved. So, of course, discussion will take place going forward, of course, during G20 Leader Summit as well. And in a due course, we can expect that some resolution will emerge.
And well, with that, it's time to take a quick breather. Don't go anywhere. After the break, we get you lots more news flow.
Hi there, welcome, and you're still watching Market Cafe on ET Now. Now let's take a look at how the Asian Pacific markets have opened up this morning, and they're looking mixed this morning following a sell-off on Wall Street and ahead of trade data from China as well as Australia. Now Chinese imports and exports for August are forecasted to fall 9.2% and 9% year-on-year respectively. On the back of that, let's look at Shanghai. Shanghai is down 0.4%. Let's also take a look at what Hang Seng is doing this morning, and Hang Seng you have on your screen down 0.7%. Now these numbers are according to a poll of economists by Reuters, which is smaller compared to the 14.5% and that 12.4% drops that was expected in exports as well as imports compared to July. Let's also take a look at Australia, because Australia has come out with its August trade data as well. On the back of that, you've got ASX 200 down a solid 1% in gain. Remember, Australia was down. It opened down in the morning, 0.5% downtick, and that downfall has continued because now Australia is down almost 1% in trade. Let's also take a look at what Japan is doing. Let's take a look at Nikkei, and Nikkei is down 0.3%. Remember, now this index had risen marginally after 8 straight days of gains, but now as you can see is down in the red, almost 0.3% down. Also, let's take a look at what Kospi is doing. Kospi is the last index that we'll be talking about today, and Kospi is also down 0.8%, close to that 1% downfall coming for Kospi as well. When we talk about GIFT Nifty currently at that 19,624 levels, compared to that 19,611 levels of Nifty that closed yesterday. So indicating to a rather flat start, not indicating much action for our markets this morning. But we'll also take a look at how that pans out for us this morning, Ankita.
That's very Snehi, but let's now take you through the lineup that we have, on the show that comes next, that is the market. First up, we have Rishabh Sheth at 9:20 from Karma Capital, and he will be giving his view of the street and the roadmap ahead. At 9:40 a.m., we have Shreyas Tambe of Biocon Biologics on the integration of Viatris done and how well is it going and what is the future ahead. At 9:50 a.m., we have Ashoka Kajaria of Kajaria Ceramics on the growth triggers for the company. At 10 a.m., we have Vinayak Chatterjee from the InfraVision Foundation on the power supply woes. At 10:20 a.m., we have Prabal Sen. He will be speaking about the pricing trends for the oil and the gas sector.
Well, with that, RBI Governor Shaktikanta Das has called for self-regulatory organizations in fintech to address data privacy and other industry-related issues. Listen in to what he had to say on day 2 of the Global FinTech Fest.
I would like to stress is the need to establish an effective self-regulatory structure, and this is very important. And this is absolutely necessary for the fintechs, for the fintech players themselves. Fintech players need to evolve industry best practices, privacy and data protection norms in sync with the law of the land, set standards to avoid mis-selling, promote ethical business practices, transparency of pricing, etc. I would like to use this opportunity to urge and encourage the fintechs to establish a self-regulatory organization or a SRO themselves. From Reserve Bank, we are willing to engage with you. In fact, we have self-regulatory organizations, what is called SROs, in other sectors also.
And well, moving on then, the goal is to reach 100 million users from a current 10 million. That's the word from Upstox company founder Srini Vishwanath. Listen in to what he had to say.
Many thanks, Srini, for joining us. GFF has been at the center of fintech, innovation, all of that, and so many spokespersons have been here. You yourself said that, it's such a grand affair out here today. GFF, what for you was the biggest theme, and, what agenda, what engagements have you had here so far?
I think one of the biggest takeaways I could get from being here is the amount of interest, the amount of demand, the amount of talent that India has and how fintech is going to play a massive role, not just for the consumers and not just for the population, but also for the creators, the entrepreneurs. There's just so much enthusiasm over here. It's overflowing, and of course having it in such an amazing convention center like this that wasn't there 3-4 years ago. It's just a testament to the high quality of entrepreneurs, investors, and general ecosystem as a whole. We started Upstocks and came here almost 12-13 years ago. Fintech wasn't even a buzzword at that, right? And to see going from there to what we have here, I think it's just been phenomenal.
Let's talk a little bit about Upstocks and dive right in and talk about where the company is at this point. You've already broke even. In 2023, the company has reached that benchmark, 1,000 crores, I believe, right? So from here, what's the next benchmark for Upstocks? What's your user base like? What's the strategy going to be going forward?
So we've been profitable for over 4 or 5 quarters, and we plan on staying to be profitable moving forward. We've recently hit 10 million users on our platform, and our goal has always been getting to 100 million users.
Well, keeping it with the Global FinTech Fest, then ET Now's Ankur Mishra caught up with Ashwini Kumar Tiwari, who's the Managing Director of State Bank of India. He talks about credit costs and the plans for YONO 2.0. Listen in to what he had to say.
So credit growth continues to be strong. Now, it is not across all sectors. It is very strong in infrastructure, solar, now warehousing, logistics, personal loans, housing loans. These are areas which continue to be strong, education loans, auto loans. But there are also certain sectors where it is still not where we perhaps would like it to be. So my sense is that as the economy continues to improve, the left out sectors also will join the party at some stage. And therefore, to that extent, the GDP growth of 6 to 8%, which is the trend which is projected and also we've seen, I think this should ensure that the credit growth continues to be strong. I mean, in India, if you have a credit growth between 13 to 14%, the general thumb rule is it should be double the GDP growth. So the GDP growth is about 7% or 14% credit growth is not an outlier. So in that sense, I don't think it's a problem. I mean, of course, there was some large pickup at just post the COVID, which was of course a pent-up demand. But that has settled down. So we don't see that kind of a exuberant growth, if you will.
So you say that the momentum may continue, but there will not be surge any further.
Yeah, surge means, I mean, we used to see 20-25% growth. That perhaps may not be the case. On an overall basis, 14 to 16% is something every bank guides for, and I think that should be sustainable.
My last question will be related to asset quality. Now, this is something which State Bank of India, being the largest bank, has improved upon quarter to quarter. 0.25% credit cost. Now, what next? You believe that there is a room for further improvement?
So I think we are in a good place now. 0.25% historically also has never been achieved. So in that sense, I think a lot of cleanup which has happened, a lot of recoveries and other cleanups. So that has resulted in this number. And the most important part is that while we are cleaning up the legacy book, the new NPAs are not happening at the pace or at the scale that they used to. So in that sense, I think we have done well. But banking is a business of taking risk. And therefore, we have to continuously be on the lookout for where the next vulnerability could be. And we continuously work towards tightening those sectors, those processes, those SOPs, where we might feel that there could be a risk. So it's a continuous process, but I think in general, the underwriting standards, the way we select clients, the way we monitor them, all of that is improved and improving as we go forward. So it should be okay, but we are in a good place. I don't think we can ever get to a zero NP, nor do we want to.
What are your aspirations for YONO 2.0?
So YONO 2.0 has just started. We have just onboarded the technical service provider, and in the timeline is about 18 months to 24 months roughly. But it will be in sprints, which means some things will go live, then other things go live, not all at once. So the sense is that as things progress, things will be upgraded, experience will be upgraded, new services are going to be added. For example, one of the major things in YONO 2.0 is the marketing tech stack, which means we should be able to market as per the customer's propensity. And that's a slightly new thing going towards hyper-personalization. And as we are able to do more of that, then the customized product which the customer might want will be possible to do. And we should therefore see much more strike rate than we see today in the vanilla products of the pre-approved personal loan which we offer to the customers.
And it's time to slip into a short break, viewers. Don't go anywhere. After the break, we get you all the stock-specific action.
Hi there, welcome back, and thanks for still staying logged into Market Cafe. This is ET Now with me, Snehi Shah, and with me is Ankita Saxena. Now, the incremental CRR may continue for few more weeks, and this is the word coming in, and ET Now has learned from exclusive sources that RBI is meeting today, and its decision may be announced soon. Ankur Mishra has more details.
Yes, sources say that Reserve Bank of India is going to review the situation on incremental CRR very soon. In fact, if sources are to be believed, the decision might be taken. Remember, Reserve Bank of India has imposed incremental CRR on banks, and this was a targeted tool by Reserve Bank of India because they found that liquidity situation has been in surplus, especially after 2,000 rupee notes were deposited in the system, and therefore this targeted approach was taken by Reserve Bank of India. But you would remember then on August 21, first time there was a situation when the liquidity went into deficit. But after that, the situation improved. Many of the bankers we have spoken to have told us that they expect Reserve Bank of India to continue this incremental CRR for few more weeks, and we need to wait and see what decision actually Reserve Bank of India considers. If you see the liquidity situation, it has already been back into the surplus, but all will depend on the assessment of Reserve Bank of India on incremental CRR.
Well, and moving on to an exclusive, sources have told ET Now that Power Ministry has asked states and DISCOMs to take immediate steps to meet the unprecedented power demand. My colleague Prakash Priyadarshi joins in with more details. Take it away, Prakash.
The Power Ministry has asked all states and DISCOMs to take necessary steps in order to meet unprecedented power demand in the country. As per the Power Ministry's data, power demand has touched all-time high of 241 gigawatt during first week of September. In fact, it has grown by 23% during month of August, which is one of the highest in the world. But the big concern for the government at this point of time is that some states are not able to supply sufficient power to the consumer. In fact, we are witnessing power shortage in several areas, especially during night. Power shortage has reached to 10,000 megawatt during night, which is a big concern for the government at this point of time. Power Ministry is also saying that below normal monsoon has led to high power demand, and depletion in reservoir levels is something which is a big worry for the government, as it is not able to generate sufficient hydropower in order to make a balance. Power Ministry is also expecting to have higher power demand going forward. Taking all into consideration, Power Ministry has instructed all states to make necessary arrangements. In fact, it has already taken several emergency measures. All power generation companies have been instructed to import at least 6% coal for blending purpose. All gas-based power plants will have to be operated with immediate effect. In addition to that, power will be sold through power exchanges in a case where states does not purchase power despite having power purchase agreement. Apart from that, states have been told to shift agriculture load on solar power. Meanwhile, Power Ministry has approached Ministry of Coal and Railways to speed up additional coal supply to the thermal power plants. But it is interesting to note that Power Ministry has maintained that there is sufficient coal stock available in the country to meet any power demand. But the Power Ministry data is telling something different. But the fact is that we have huge power demand in the country and a power shortage as well during non-solar hour.
All right, thanks Prakash for taking us through that. But Amrit Lal Meena, who is the Secretary of the Ministry of Coal, says that India has adequate coal stock at all thermal power plants, and he also sheds light on the ministry's future plans of setting up new thermal power plants. Now, ET Now spoke to him exclusively. Listen into an excerpt of what he had to say.
Last about 1 month, the demand for power is increasing because of the long dry spell. But as far as the coal availability is concerned, all three ministries, Ministry of Power, Railways and Ministry of Coal, are working in close coordination and ensuring adequate availability of coal at all thermal power plants. We have a stock of about 58 million ton at our mine end also, and we have adequate stock at the thermal power plant. See, Ministry of Power has plans for year 2030, and in that plan 4 thermal power plants of Ministry of Coal are also proposed.
And well, Madhvi Puri Butch had to say to fintechs and influencers at the Global Fintech Fest, she emphasized on the market regulators' efforts to crack down on the unscrupulous marketing and clickbaiting to quote unquote seduce investors into spending thousands and lakhs of rupees, promising blockbuster wins and profits. Now, just last week, SEBI released a circular listing guidelines to help curb this problem and protect the investors.
My ask from fintech is the same. You know what you are doing, if you are building a platform that allows people to literally seduce people into the market and make them lose their shirt. And then you say, I'm only a platform. But there are thousands of people who are losing their money, their hard-earned money because of what you are doing. You know. You don't need a regulator to tell you. So what does your conscience say? Would you recommend your service to your mother-in-law?
Well, CLSA has released a bullish note on electronic manufacturers. The likes of Amber Enterprises, Dixon and Keynes Tech are in focus because of that. Let's go across to my colleague Winnie, who's standing by with more details. Good morning, Winnie. Take it away.
Good morning, and absolutely they have come out with an initiation coverage on Amber Enterprises, Dixon Tech as well as Keynes Technology. All these are electronic manufacturing services, and now what they are doing is that why do they believe in this is one, there's an aggressive policy support that is coming in for EMS manufacturers. Overall, the global supply chain, there's a shift also coming towards India which is going to be benefiting the Indian companies, and the scale and opportunity that they see is 20 times in 2 decades. Now for Amber Enterprises, let's not forget, they believe that it is going to be benefiting from the focus and consumer adoption of room AC and air conditioners. So that will be supporting the rising growth for Amber Enterprises. Dixon Tech, obviously, you know, the growth that we are seeing in mobile phones, they believe that mobile phone manufacturing companies like Dixon Tech will be supporting the growth, and that will be driving the growth for Dixon Tech. And Keynes Technology, they are highlighting that Keynes Technology is quite diversified in terms of their presence across various segments and industrial segments as well, which will be a support for Keynes Technology. That's why initiating coverage on these 3 companies. For Amber Enterprising, initiating with a buy and a target price of 3,650 rupees per share. Dixon Tech, they're initiating coverage with an outperform rating, target price of 5,675 rupees. And Keynes Technology initiating coverage with an outperform rating and a target price of 2,230 rupees per share.
All right, Winnie, thank you so much for that snapshot of all the brokerage notes coming in this morning. But let's take a quick breather. When we come back, we get you all the stocks that you need to keep on your radar for this trading session. Welcome back. You're watching Market Cafe. Now let's shift gears and look at some of the management meets that took place recently. Now Investec has come out with its note on Equitas SPF's management meet. Now while Morgan Stanley has noted the highlights of ICICI Bank's meet, my colleague Harsh is here with all the key takeaways. Take it away, Harsh.
Well, yes, let me first start off with Equitas. You've got loan growth, which is very solid underlying, and you're seeing 25 to 30% loan growth, which is expected, which the bank management is expecting. In fact, 25% over the next 5 years is what they're comfortable guiding for, which is quite strong. So that's one piece of the guidance. The other one is asset quality remaining largely stable. They are expecting credit cost to be around that 1.2% mark, and operating leverage should play out because top line should grow at roughly 25% and your operating expenses should grow at 20%. So on the back of that, they are expecting that operating leverage to start to play out, cost to income ratios to fall. You're seeing margins which are under pressure is what the management is suggesting, largely on the back of the fact that they want to scale up the cost to deposit ratio. They want the credit to deposit ratio, my apologies, because they want deposits to start to come through, and on the back of that they are expecting some pressure on margins. Let's quickly move on to ICICI Bank. Well, the management suggesting that loan growth continues to remain strong, the competitive intensity is high and growth is not really impacted. Margins will moderate as funding costs start to catch up. They are expecting to maintain those margins in FY24, which they've done in FY23. They are looking to accelerate branch expansion as well during FY24. Asset quality, of course, remains solid and benign, and given the data availability, good macro conditions, that's aiding asset quality at the moment. Even on the unsecured and MSME, which has been a concern, better rated customers are continuing to perform well. So ICICI Bank also giving out some bullish commentary on that front.
All right, Harsh, apologies. Thanks for taking us through that. But we've also been joined by Ansh in the studios. And Ansh, take us through what the FNO setup looks like for today. What are the options indicating?
Sure. So Nifty in the previous session had given a wild ride actually. It started high, dropped over 100 points to 19,500, bounced back from there by over 100 points to close about 19,600. Now, like we discussed yesterday, Nifty seems to be in a comfortable zone of 19,450 to 19,650, and the previous close seems to be near this upper range of the resistance. Now let's see what happened in FNO segment. Nifty futures open interest increased by 0.8% and gave a flat closing in future market. This indicates neutral stance. On option front, we saw active put writing at 19,550 and 19,450, which indicates that option traders are expecting these levels to give a good support in the coming sessions. Also on upside, some resistance lies at 19,700, where strong call writing is seen by over 1 lakh contracts. Now let's shift our focus to what FIIs did. In index futures, FII covered 450 long contracts and they added 2,500 shorts. This clearly shows their bearish view on market actually. Whereas in index options, we see all positions getting covered, be it call longs, call short, put long, put shorts. This usually happens when traders are either clueless on where the market is going to go or they expect market to stay where it is. So in a nutshell, despite of the positive movement in Nifty from last 3-4 sessions, the FNO data shows some bearish sentiment in the market. Also today is Nifty weekly expiry, so expect some volatility in the market before the close.
Thank you so much for that, Ansh. But we'll move on. The Indian pharmaceutical sector has reported a single-digit growth in August for the 4th consecutive month due to the high base and challenges in the volume growth. My colleague Ashesha is joining in with more details on this. Over to you, Ashesha.
Yes, pharma stocks in focus, and this because Indian pharma market has been growing. It grew in mid-single digits in the month of August, and this is for the 4th consecutive month. The whole market grew by about 4.1% on a year-on-year basis, and the growth in this month was mainly led by the price hike that the companies undertook in the month of August. Prices rose by about 5.1% on a year-on-year basis, but this was offset by decline in volumes that we saw. Volumes declined by about 3.1%, and hence it mitigated the benefit of price hikes that the companies had undertaken. Derma, pain and gastro were the major drivers for the industry in the month gone by. Derma registered a growth of 6.1%, pain of about 6.3%, and gastro segment registered a growth of about 5.7% in the month of August. Respiratory segment meanwhile saw a decline of a marginal 0.2% on a year-on-year basis. As far as company and stock specific action is concerned, Sun Pharma, USV, Torrent and Mankind grew faster than the industry, while Pfizer, Emcure and Sanofi witnessed a decline. So on account of this data that has come in for the Indian pharmaceutical industry, all of these counters will be in focus today.
Absolutely, Ashesha. We will be keeping all of these counters in focus and on our radar this morning. But with that, let's go back to Ansh, who's joining us for all the stocks that you should be keeping on your radar this morning. Ansh, take it away.
Sure. So, in Swift Laboratories will be the first stock in focus for today's trading session, as India RF, a prominent investment platform supported by Pyramid Enterprise and Bain Capital, is set to acquire API and CRAMS business of the company for 1,650 crore. Apart from this, Tata Motors will also be in focus, as Jaguar Land Rover is strengthening its partnership with TCS for digital transformation. Force Motors will also be in focus on the back of the operational updates that the company has shared for the month of August. Company had a total production of around 3,032 units. Out of this, around 2,600 units were sold domestically, while the remaining were exported. Moving on to Lemon Tree, company is opening a new 48-room hotel in Himachal Pradesh. The hotel is projected to commence operation in the first quarter of 2026. Lastly, JK Cement will be in focus, as Kotak Mahindra Mutual Fund has acquired shares of JK Cement, constituting more than 5% of issued share capital. So keep an eye on the stocks.
All right, we will be keeping an eye out on all those stocks then. But a couple of brokerage notes that have come out by Macquarie, Goldman Sachs, and of course Nomura. But Vamakshi has all those notes. Vamakshi, tell us, what are these brokerage notes saying? What are the stocks that we need to keep on our radar for today?
Well, yes, let me first start off with the IT sector. We have a brokerage note coming in from Nomura, and largely what they've highlighted is the fact that revenue growth is expected to pick up from FY25 onwards, and this is aided by large deals. Margin improvement is expected, but it is expected to be slow. They, however, remain cautious on the sector given limited visibility on a significant turnaround in the discretionary demand for IT services. So all in all, they've maintained their buy rating on Tech Mahindra, Coforge, Birlasoft. They've maintained their reduced rating on TCS, LTI Mindtree, Emphasis, as well as LTTS. They maintained their neutral call on Wipro, HCL Tech, as well as Persistent, while they've upgraded their rating from reduced to neutral for Infosys. Other than that, keep an eye out on Indigo. We have a note coming in from Goldman Sachs, and what they have highlighted is that lower yields as well as higher fuel prices could drive a weak quarter two. They're expecting a loss of almost 11 rupees per share in the second quarter. But despite that, Goldman Sachs has maintained its buy rating on Indigo with a target price of 2,600 rupees per share. And lastly, keep an eye out on HDFC Bank. Macquarie believes that the low credit costs are expected to drive the bank's return on assets to 1.9% in the second quarter. The PPOP growth, that is the pre-provisioning operating profit growth, is expected to be low, and that is mainly on account of higher operating expenses as well as the near-term pressure on margins. HDFC Bank, in their opinion, is a marquee buy idea, and in fact is their top pick in the sector. So given those factors, Macquarie has maintained its outperform rating on HDFC Bank, target price of 2,110 rupees per share.
Well, Ramakshi, thanks so much for taking us through what brokerages are keeping on their radar this morning. We also will be keeping an eye on these stocks. But with that, let's look at FPI flows for the month of August, which has moderated after 3 months. Now, 9 out of 14 sectors have witnessed inflows, which include power, capital goods, as well as pharma, while you've got metals, banks, and financials, along with real estate, that have witnessed outflows. Sharad is here with more details on this. Sharad, take it away.
Well, yes, for the month of August, we see the FPI flows have actually moderated, and of course, the last 3 months itself, we see there was buying coming in, but the moderation is coming in. Of course, the power, capital goods, and the pharma, that's where the buying streak is continuing. But the metals, banking, reality, that is where the outflows are being seen for the month of August. Now, let's look at cement and construction. That is also having a 14-month straight inflows coming in. And do remember, out of the 14 sectors we are tracking, 9 of them have still seen inflows coming in. Also, if you look at the auto sector, they have also received 8 months straight of inflows. For financials also, over the period of 6 and 12 months, there has been maximum inflows coming in, and financials includes banking as well. And in terms of IT, however, if you see maximum outflows coming in for the next 6 to 12 odd months. Now, if you see the trend itself from the January, there was kind of an outflows coming in. But if you see for June, July and May, that is where the total FPI inflows were above the 5 billion mark. And now there has been a slight moderation coming in when it comes to the FPI. But now let's look at how the overall change in FPI inflows have been there for the sector wise, and that is where the numbers come in. That is where the power, capital goods, as well as IT, all of them going above the 500 million mark. But if you look at the metals, BFSI and the real estate space, that is where the majority of the selling has been seen.
All right, thank you so much for that. Now we'll move on. The real growth story is coming from the mid-cap space, according to Ajay Srivastav, who's the CEO of Dimensions Corporate Finance Services. Listen in to find out where he finds value emerging.
India is a market of flows. I think that's where we are at this point of time, that the mid-cap, small-cap mutual funds are driving this market into PE expansion. I don't think people are expecting them to grow very much, but the PE expansion is now getting into a zone which, hopefully the festive season will give one positive surprise to us. But if it doesn't, you could have a lot of grief sitting all there. Having said that, what is also happening is, over the last 3, 4, 5 years, so many companies have come into this market which have got new themes, new industries, unexplored sectors, that compared to the original concept of buying cement, bank, and those kind of stuff, steel, now people are buying different kind of set of companies which are primarily available only in the mid-cap space. So I think it's logical that the real growth stories are going to come from the mid-cap space, because those are the new sectors, those are the new companies, and therefore they can grow at 20, 30, 40%. Their large caps may grow at 10, 15% at the best possible thing.
Well, that's the word coming in from Ajay Srivastav. But with that, I'm afraid we're completely out of time on this edition of Market Cafe. But while we bid you goodbye, you don't go anywhere, because the market takes all the action ahead. So stay tuned to ET Now.